In your personal finances, it's better to have a huge rainy day fund and as little debt as possible. Everyone agrees with that. In this video, we're looking at a cash machine that has very little debt and dominates in two categories. Growth with some sort of safety net is rare these days, but Alphabet cannot be ignored right now. Earnings will be announced today after the close. What will happen? Here are some very good reasons you should take a closer look at Google. Are you ready? Let's go. This is not investing advice. Please make sure to do your own due diligence before you ever invest. Alphabet is a beast. Without a doubt, it's one of the premier businesses on planet Earth. It really goes without saying, but Google is the #1 search engine, and it's not even close. Google has become the verb for searching the internet, and you know what that means. Absolute dominance. Then, of course, there's YouTube, the platform that we're both using right now. The amount of usage for YouTube is mind-blowing. Listen to this. There are 2.6 billion, with a B, active users on YouTube. Daily active users are 122 million. That's unbelievable. The average user spends 18 minutes per day on YouTube. Guilty. How many daily hours are watched? 1 billion hours of daily video. What about uploads? There are 500 hours of video uploaded every minute. If that's not dominance, I don't know what is. By market cap, Alphabet is the third largest company in the United States, eclipsed only by Apple and Microsoft. In February, the juggernaut reported Q4 earnings and quarterly revenue was $75 billion. That's $25 billion every 30 days. The 2021 total revenue was $257 billion. That number is approaching $5 billion every week. I cannot wrap my mind around that. Stay with me for a few seconds here. $5 billion every week means $1 billion a day, Monday through Friday. Divide $1 billion by 24 hours, and the hourly revenue is over $41 million. These crazy numbers become even more mind-blowing when you consider that Alphabet's revenue was up 32% quarterly and up 41% for the year. So what will we hear today about quarter one? Of the $257 billion of revenue in Q4, they were able to squeeze out $67 billion of free cash flow. That's super impressive. But with those outstanding numbers, all the talk was about the 20-for-1 stock split announcement. Now, here's a little piece of information that's got us putting our new dollars to work right here. With all this news, Alphabet is approximately $300 per share cheaper than it was when it announced the stock split. Wow, that's a lot of catalysts, but the reason to consider buying shares just keeps getting better. Can you say cash? In Q4, it reported Alphabet disclosed almost $140 billion in cash and securities on their balance sheet. That's an unbelievable stockpile of cash. And the machine just keeps cranking out the Benjamins. Their debt was only $14.9 billion, just a little over 10% of their cash pile. That makes the possibilities almost endless. Will they continue to acquire businesses to compound the cash machine? Probably. Will they use the stock to buy back shares? Probably so. Either way, the cash pile and the ability to generate free cash flow makes Alphabet a wonderful, wonderful investment. Let's look at cloud computing now. Amazon and Microsoft are certainly the big dogs on the porch, but Google Cloud is coming on strong. In 2021, revenue increased year over year, but showed a loss as they are building out their server infrastructure. This will soon become another cash generator, probably this year. Google Cloud is building up a real head steam, and it's another reason that we're putting our new investing dollars to work right here by dollar cost averaging in. The last reason is this. Google search and YouTube are absolute category dominators. 86% of internet searches happen on Google. 76% of all videos watched are on YouTube. When categories are dominated to this magnitude, digital advertisers are throwing money where the eyeballs are. Google ad revenue grew at 36% year over year last year, and YouTube's revenue grew at 25%. That's amazing. Is Alphabet expensive? Not really. It's trading at less than 22 times earnings, and that's not bad for a company that has 32% revenue growth. So to summarize, You get the stock split if you buy before July. You'll get stock buybacks over the months and years, and you'll get multiple acquisitions over time. You'll get the future cloud computing monster that's being built, and then there's the steamrolling cash generator that just keeps printing. Earnings are today, April 26. So will ad revenue be up or down? Will the China shutdowns, the economy, inflation, and war rear their ugly heads when Alphabet reports today? We will see shortly. What do you think? Do you own any Alphabet, or are you buying before earnings? Or do you think that it's too expensive and it may drop hard after the earnings report? Let us know in the comments below. Check out this video right here for more investing ideas. I'll see you in the next one. Have a great day, everybody.